Good day friends. In the subject of personal financial planning, we are having the lecture series on risk and return. In this lecture, I'll be talking about measures to evaluate risk, means what are the different methods of measuring risk. And in the lecture series on risk and return, we talked about what is return, what is holding period return, what is realized return, what is expected return, how do you calculate the return of any asset. And we also talked about in my previous lecture on risk, that what are the different type of risk that are being involved while you invest in any asset. That is systematic risk, unsystematic risk, why does the systematic risk arises, and what are the reasons of unsystematic risk. These were the few things which we discussed in our previous lectures on risk and return. I'll be focusing here on the quantitative measures of risk, means what are the different methods by which you can evaluate the risk of an asset, and especially we'll be talking in context of the equity shares. One method is called range, the other is called standard deviation, variance, coefficient of variations, beta. These are the few methods by which you can measure the risk. Let me discuss one by one in little bit of detail. When you talk of the range, it is the difference between the highest return and the lowest return. That is, when you invest in an asset, what are the chances, if I talk in terms of the expected return, what are the chances that this will be the maximum return which you expect from investing in that asset? And what are the chances that you will be getting the minimum return? Means how much is the minimum return you expect from that asset. So means what is the expected maximum return and what is the expected minimum return. The difference of the two is called range. It may be expected, it may be realized. When you calculate the risk, what is the risk involved? That if an asset class has given you maximally return of 20%, and if the lowest return in a particular time period or at a particular point of time was 10%. So the difference between 20% and 10% is called the range. And higher is the range of an asset, the higher is the range of the return of an asset, more is the risk involved in that investing in that asset, or more is the risky asset that is. If I talk in terms of equity, that higher is the risky equity investment of that particular share which you are buying or selling. So it means that the difference between the highest return and the lowest return, not the lower, it is lowest return, is called the range. According to this measure, an asset having bigger range is considered to be more risky than the one having smaller range, right? So means when we talk of the range, you differentiate the two and find out the range. If the range is high, it means the asset is more risky. If the range is low, right, it means the asset is less risky. If I take an example in terms of equity, like for example, if I talk of a company, I'm not naming the company, which are say blue chip companies or the listed in the NSE, right, and they are in the Nifty, they are the part and the parcel of the index. Normally the range varies in these equity, return of these equity is less. If I talk in terms of the FMCG company, fast moving consumer goods company in India, like for example ITC, Hindustan Lever, Patanjali Food, what you will observe is the highest return and the lowest return in these companies is not much significant, right? So they are considered as less risky investments. On the other hand, if you take the example of, say for example, commodity shares like sugar industry, companies which are in the sugar industry, companies which are in the steel industry, you will find there is a huge difference between the highest return and the lowest return. That's why these shares are being considered as more risky. So means, in a nutshell, that higher is the range, higher is the risk, lower is the range, lower is the risk. The other very popular method and considered to be the scientific method of calculating risk is called standard deviation. Most popularly and most used method is of calculating the risk is called standard deviation. It measures the quantitative risk, the total risk involved in an asset, in an investment. So standard deviation is the most common quantitative measures to calculate risk of an asset. It measures the dispersion of periodic return from its expected value or mean. How much return you have got by investing in that asset, and what was the average return you was expecting, means mean return, expected value or the mean return, because expected value is on the base of mean return. Mean return is nothing but the average return that over a period of time that asset class has, or that equity or that asset class has given you this much of return. That is the mean return. If I say, if the person has invested in gold, right, in the last 50 years, the gold has given you, in a time period of 10 years, if you calculate the average, the gold has given you 10, 11 or 12% return. So this is average return. Now you calculate that how much the return of the asset is different from the average return of that asset, right? So it measures the dispersion. Dispersion means variation, dispersion of periodic return from its expected value or mean. It indicates how much of the current return is deviating from its expected historical normal returns. As I said, historically, in a, say for example, in a 50-year period, if you talk of the real estate in a period of 50 years on an average, in a year, how much it has given return on an annual basis. And you compare this mean return with the return of a particular period, right? That will measure the standard deviation. That will measure the risk of that investing in that asset. So a square root of variance is standard deviation, right? So variance, I'll be talking I can say the standard deviation, square of the standard deviation is called variance, right? Or I will put it this way, square root of variance is called standard deviation. For example, a stock with high standard deviation has higher volatility and thus to be considered riskier. Means it is basically the interpretation of the standard deviation. A stock which is, when you calculate risk by using the standard deviation and you find that standard deviation is high, it means the asset is more risky. And if the standard deviation is low, it means the asset is less risky. So as a result, the investor prefers investment with higher rate of return and a lower standard deviation. So certainly every investor is risk averse, and if the investor is risk averse, so certainly he would like to invest in an asset which give you higher return but a lower standard deviation. So how do you calculate? There is a formula of calculating standard deviation. I mean, there are two ways of calculating standard deviation. The example which I have taken here, that is, there is a probability is given, probability of getting a XI return. XI means the return can be this much. When you invest in an asset or different asset, what are the different probabilities? If the situation is good, what will be the return? If the situation is normal, what will be the return? If the situation is bad, what will be the return? Right? This is called probability of I, probability of good situation, probability of normal situation, probability of the bad situation. So N in our case is 3. So Pi, it is basically the Pi in this case from 1 to N, summation of Pi, Xi means return in the ith. If the situation is good, what will be the return? Normal, what will be the return? Bad situation, what will be the return? Minus average return. X bar is called average return, right? So Xi minus X bar whole square, and you multiply it by Pi and whole under root. That will give you the standard deviation. So Pi is the probability, Xi is return from a security, X is the expected return, you can say mean return, right? So Pi summation of Xi minus X bar whole square whole under root is the formula of calculating standard deviation when the probability is given, right? If the series of return is given over a period of time of a particular asset, then the formula will divided by N, right? So here I am taking an example where the probability factor of a given period, in a given period, if I say in a particular year, in the year 2023, what will be you want to calculate the standard deviation risk of an asset, of a particular asset class. In that case, how will you measure the standard deviation? So 3 situations I have assumed. That is, if the situation will be good, what will be the return? Normal, what will be the return? If the situation will be bad, what will be the return? Then we calculate average return and we apply this formula, thereby you can find out the standard deviation. Now let me take an example. Here in this example, what I have taken is, instead of one particular year, I have taken 10 different years, right? So there are 10 different years and an asset has given us in these 10 different years different percentages of return. In first year 10%, second year 12%, in third year it is 8%, in fourth year it is 5%, in fifth year it is 10% again, sixth year 13%, seventh year 7%, and so on and so forth. Means 8th year 5%, ninth year 8%, and 10th year 12%. This is, return in terms of percent. R here refers to the return in terms of percentages. In the formula, I had used the word R or X, right, where the standard deviation was X. So this is nothing but the X or R, whatever the nomenclature you want to give. So this is, if this is the return which an asset has given, and now you want to find out the standard deviation of this asset, how you will calculate it. So we will apply the formula. First of all, the return is given, you make summation of the return. 10, 12, 8 means over a 10-year period, what is the percentage of return that has been given by the asset, you make summation of it. This comes to be 90. Means when you add 10, 12, 8, 5, 10, 13, 7, 5, 8 and 12, it comes to be 90. And you will calculate the average return. 90, the sum total of 10 years return, the time period is 10 years, so 90 divided by 10, so it comes to be 9%. It means the average return over a period of time for this asset is 9%, right? I have not calculated it, I am telling you. So you add the make summation of the total return, divide by number of years, that gives you average return. Now in the next column, we have calculated RI minus expected return whole square. RI means return in a particular year, R bar means average return, which I have just told you 9%, and the whole square of it. That is, in the first year, 10 minus 9 is equal to 1, whole square of it 1. 1 square 1. Then 12 minus 9, it comes to be 3, 3 square 9. 8 minus 9, 1 minus 1 whole square 1. 5 minus 9, 4, 4 square 16, and so on so forth. Means it is return minus average return whole square of it. So 10 minus 9, 1, and 1 square 1. 13 minus 9, 4, 4 square 4. 7 minus 9, 2, 2 means that is square 4. And in this way, you have calculated R minus R bar, that is return in a particular period minus average return whole square of it. You make summation of it, that comes to be 74, right? So the mean return is 9%. So standard deviation will be 74 divided by 10. 10 is your time period. That is, in the formula, if you recollect, the formula which we have used is Pi into Xi minus X bar whole square whole under root. That was for a particular period. If a series of return is given in a particular asset, means instead of probability, it is a return of particular period, time period, that is 10 years, 5 years, 15 years, 20 years, then the formula will be the standard deviation of summation of the return over a period of time, Xi minus X bar whole square divided by N under root. So in this way, if you calculate this, you will find out this is 74 divided by 10-year period, N is 10 in our case, 10 is number of years of which we have calculated, and this 74 have been calculated R minus R whole square, summation of it is 74, that is 1 plus 9 plus 1 plus 16 plus 1, 16, 4, 16, 1, 9, the summation of it comes to be 74. So standard deviation is equal to 74 divided by 10, that comes to be 2.72. Hence the return on a security is 9% with a total risk of 2.72%. And if I talk in terms of variance, simply is the square of the standard deviation is called variance. So that is 2.72 multiplied by 2.72, that comes to be the 7.4, which is called squared percentage. In this way, you can calculate the standard deviation, and as I said in the beginning, it is the most popular method of measuring the risk, right? This is what we know as the method of measuring the risk by way of standard deviation. The other is called variance. As I was just talking to you that when the square of this standard deviation, that is 2.72, the square of it comes to be the variance, right? So variance is another method of calculating risk. Variance is a statistical concept that describes the range of an investor's expected return within which it can be reasonably expected to fall, right? So variance means, when you talk of the variance, I mean, it's a statistical concept that use the word investor's expected return, which is it can be reasonably expected to fall. That is how much the fall it is expected by which you measure the risk. So it is used to measure total risk of the security. Friends, if you recollect, in our previous lectures, we talked about systematic risk and unsystematic risk, right? Systematic risk cannot be diversified. As far as the unsystematic risk is concerned, that can be diversified. When I use the word systematic risk cannot be diversified, what it means is that systematic risk affects all different equity class or all different type of assets, right? But unsystematic risk is company specific, it is particular asset specific. So if I talk in terms of the equity, in systematic risk, basically it is because of inflation, it may be because of the exchange rate risk, it may be because of market risk, means whenever the market changes because of it, means sometimes there is a boom period, sometimes there is a depression state, right? Boom and gloom is the normal nature of the market. So if there is a market changes, all asset class or all equity, if I talk in terms of equity, different shares gets affected by it, right? If there is a inflation, it makes an impact on all the company. If there is a change in the exchange rate, it makes an impact on different companies which are listed in the stock exchanges, right? So there are many reasons when monetary policy changes, when fiscal policy of the government changes, there are geopolitical risks. All these risks, these are called systematic risks. This affects all the companies, this affects all different asset classes. On the other hand, there is unsystematic risk, which is company specific. Unsystematic risk, basically it is because of the how you have financed the business, what is the level of operating leverage in the business, what is the level of fixed cost in the business. Means there are two, one is called business risk, other is called financial risk. Business risk means how you have financed the business. I'm talking of, when we are talking of total risk, I'm saying there are two types of risk involved: systematic risk and unsystematic risk. Systematic risk means which affects all the companies, which is not diversifiable. Unsystematic risk means which is company specific. I'm giving you the example of the unsystematic risk, which is company specific. I'm saying it is because of two reasons. One is because there is the way you have financed the business, which is called financial risk. The other is operating risk. Operating risk means that what is the percentage of fixed cost in a business. If the fixed cost element is very high, if the sale is not high, certainly there will be higher per unit cost, right? So the chances of profitability is low. Profitability will come when the sales volume increases. So that is also known as degree of operating leverage. The other is called financial risk, how you have financed the business. Means how you have financed means there are two broad components, debt and equity. If the equity component is high, there is no fixed interest cost involved. If the debt component is very high, the fixed interest cost is very high, right? So in a situation, if there is suppose slowdown in the business, in that situation, your sales are not high, your total revenues are not high. So since you have to pay, it will lead to lower profit, and you have to pay very high fixed cost in terms of the interest, because you have taken too much of leverage or too much of debt from outside for financing your business. So how you finance your business, that measures the financing risk, right? And in your business, I mean, how much is the fixed cost and the variable cost component, that measures the basically the operating leverage part, that is the business risk. So anyway, what I'm saying is that variance measures the total risk, whether the systematic risk or unsystematic risk, means it measures the total risk. There are certain methods which measures only systematic risk. I'll be coming to it later on, that will be talking of beta, but here I'm saying the variance measures the total risk involved in any security. So square of standard deviation is known as variance. Means when you talk of the variance, simply the way you have calculated, let me come in again to this example. What we have done is we have calculated standard deviation first. That is standard deviation, simply say the whole under root of summation of Ri minus R bar whole square divided by N. N means over a period of time. If you have calculated the return of a particular period of time, means thus 10 years, 15 years, 20 years, and on the base of that you are calculating the risk of an asset standard deviation. And you simply, I mean, square root of, the square of this standard deviation is called variance. And variance is being considered as a better measure of measuring the risk as compared to the standard deviation. But see, when you talk of variance, when you talk of standard deviation, it is a particularly absolute value of risk. We say this which is a standard deviation. 2.74 in our example was the standard deviation of a particular asset of a 10 years return. But when you are comparing the two assets, absolute number of or absolute risk percentage will not give you the clear idea, because it depends on the amount which you have invested in an asset. It depends on various factors. So we say, in order to measure the relative risk of the securities different asset classes, the coefficient of variation is a better measure of measuring the risk. And what is this coefficient of variation? It is a relative measure of risk. Relative measure means it is basically when you are comparing the two asset class, or if you are comparing the two equity, which is more a riskier in equity as compared to the other equity, other share, right? So it is a relative measure of risk. Coefficient of variation is used where we want to compare two or more securities having different average return, right? I mean, average return over a period of 20 years in one asset is a particular say 12%. In other, it is 14%. Now, can you say the asset which is giving you 14% return is better as compared to the asset that is giving you 12% return? Outrightly, you cannot say the standard deviation or the variance will not give you the right answer of measuring this risk. So that's why we use coefficient of variation. Means when we compare two or more securities having different average returns, then we use the term coefficient of variation. How do you calculate coefficient of variation? Coefficient of variation, for that, first we measure the standard deviation, as we discussed earlier. Standard deviation, which is also one of the measure of calculating the risk, divide by mean. When I am saying mean, means mean return. So standard deviation divide by mean return into 100. That is coefficient of variation. So securities, like say if your standard deviation is 4, 5, 3, whatever it is, divide by mean. Mean means mean return into 100. So if you're comparing two asset, or if you're comparing two equities, two shares, right, then you will calculate the coefficient of variation of both the equity. First you will calculate standard, say there are two shares, suppose X and Y. So first you calculate the standard deviation of X, then you calculate standard deviation of Y. You calculate mean return of X security, mean return of Y security. As I was saying, mean return of one security is 12%, mean return of other security is 14%. You have calculated standard deviation of both the securities separately. So simply standard deviation of that security of X security divided by mean of the X security into 100. Right? Similarly, standard deviation of Y security divided by mean of the Y security into 100. That will give you coefficient of variation. So, security with a high coefficient of variation represent more availability and less consistency in return. Right? What it means is that in any asset or any equity which is having high coefficient of return, coefficient of variation will represent more availability, means higher risk involved and less consistency in return. If you are a risk averse investor, you would not like to invest in a security where the coefficient of very high, because it gives you high variability of return. If you are a risk seeker, you love to take interest, right? Then you may invest in a security in an asset class which is having a high coefficient of variation. So friends, in this lecture we have talked about 3-4 measures of the calculation of risk. Basically we started with range, then we talked about the standard deviation, then we talk of the variance, and finally we talked about coefficient of variance. Thank you very much.